Okay, today we will do financial statement analysis, very simplified financial statement analysis. Title of today's lecture is Examining Financial Health of a Company. Okay? Financial analysis is essentially to examine the financial health of a company. And you will be doing a little bit of it by next Wednesday. Next Wednesday's what you submit will be a little bit of financial statement analysis by looking at balance sheet, income statement, and other financial statements to see how good the company is. Last time we talked about balance sheets and income statement and cash flow. Balance sheet is a snapshot of the company's operation at a given point in time, typically at the end of a fiscal year. What does the firm look like? What does the firm's assets and liability structure look like at the end of each fiscal year? That's balance sheet. So balance sheet shows you a picture of the company structure and operations at a given point in time. Income statement is, on the other hand, is like a video. Is a video recording of the company's operation for a period ending at the fiscal year end. It's a video recording of a company's sales and company's activities to generate the sales. So balance sheet is for a given point in time, and income statement is for the entire period. Okay, you've seen that the last time. And we also talked about cash flow. And cash flow was at the center of our discussion. I talked about cash cycle. Cash goes into raw materials, and raw materials becomes finished goods inventory, and finished goods inventory will be sold to generate accounts receivables, and receivable will be collected to bring cash to the firm. And this is so-called cash cycle. And the company's operation is around this cash cycle. Of course, there are property, plant, and equipment. There are capital. There are human resources. There are technologies. But with all that considered, the company's operations are essentially the cash cycle. This is called operation of a firm. Operation of a firm. And accountants call that production of a firm. But it's operation of a firm. This is procurement. And this is production. And this is sales and marketing. And this is collection. And this entire thing is called operation of a firm. And operation of a firm is running this cash cycle many times a year. And at the end of the year, the company's operations yield profit. And the profit will be paid out as dividends and retained earnings. And retained earnings will be added back to the company's balance sheet in the capital section. Shareholders' equity will go up by the amount of earnings that are retained. And the amount that is retained is after dividends, and there is something called dividend per share. Dividend per share. If you divide the amount of dividends with number of shares outstanding, you have dividend per share. And profits, earnings per share. Again, profits divided by number of shares outstanding, you have earnings per share. And dividend per share divided by earnings per share is at times denoted as Greek letter theta. And this is for payout or dividend payout ratio, or more simply, just payout ratio. And I think you've done your project segment 1 to tell me about dividend per share, earnings per share, so you can calculate dividend payout ratio automatically from that. Okay, this is a balance sheet and income statement information. And financial analysts would like to see, actually, not only financial analysts, but firms' decision makers are also interested in looking at how this cash thing, or fund, or sometimes it's called cash are generated. Where do they come from and where do they go? In other words, sources and uses of the fund, or sources and use of cash, becomes a very interesting piece or important piece of information for decision makers as well as investors outside. So we would like to look at this sources and uses of funds today, and moving on with financial statement analysis. Okay, this is the lecture outline for today. Cash flow and financial statements, a closer look. Common size financial statements, which you will be doing by next week. Ratio analysis, you've done it for today's discussion today. The DuPont identity, that will be discussed today. Using financial statement information, if we have time, we'll get into that as well. Here's a sample balance sheet. You've seen the balance sheet already, so I'm not going to go over the sample balance sheet. And here's sample income statement. Sample balance sheet and sample income statement are used to generate sources of and uses statement. Statement of sources and uses of cash. That will be shown in a few minutes. But before that, let's, in words, what the sources and uses of cash look like. Sources of cash or sources of funds include the following 3 items. Cash inflow. Cash inflow occurs whenever the company sells something, its products, or company sells its assets to generate cash. The company sells its securities, common stock, bonds, notes. Some of these companies' papers can be sold, and that generates cash. So that's they are cash flows. Whenever a company sells something, the company generates cash inflow. Company can also generate cash inflows by decreasing asset accounts, such as accounts receivable. Here, accounts receivable. A decrease in accounts receivable means it is collected, and cash increases because of the collection. Therefore, decrease in asset account is equivalent to addition of cash or funds to the firm. Inventory, likewise. And net fixed assets. The company has fixed assets. If fixed assets have come down, that means that the decrease should be equivalent to company's cash inflow. Increase in liability or equity account also are the sources of fund or sources of cash. Accounts payable, increasing account is payable. In other words, increasing the amount of purchase of raw materials on credit, accounts payable go up. That reduces the use of cash. Therefore, net cash increase is resulting from accounts payable reduction. Other current liabilities in the same way. Common stock, issuance of common stock is also bringing in additional capital, additional cash to the firm. So these are the sources. How about the uses? as cash inflows are sources of cash, cash outflow is the use of cash. Occurs when the company buys something, products, raw materials, assets, or securities. The companies can sell securities, that's called issuing securities. The companies can buy securities, that's called refunding or redemption of bonds or stocks. Increase in asset account, cash and other current assets, increase in this is the use of fund. A decrease in liability or equity account, notes payable and long-term debt, they are, if they decrease, that means the company is paying back notes payable or long-term debt. Therefore, cash balance will come down. Therefore, they are called uses. So sources and uses. I know it's very vague and confusing. Never mind. That happened to me too when I was at your stage. It's always confusing, especially if you try to memorize these things. I'm 150% sure that you will get confused. So please don't memorize. Then how can you understand? Well, simple way to understand is to understand. Understand. Do not memorize it. Try to understand it. And you can understand that by looking at actual numbers. So let's look at some of the numbers, actual case of cash flows. But before we go there, statement of cash flows can also be looked at from different perspectives. The company's operations are usually categorized into three. Company's management is categorized into three different activities. The first one is operating activity. Essentially this. Includes net income and change in most current accounts. This tells you the operation of it. Accountants call that production. That's why I put P, production. P denotes production or operation. Investment activity, investing in fixed assets. They're called investment activity I. Financing activity includes change in notes payable, long-term debt, and equity accounts, as well as dividends. This is just financing, generate the securing capital, securing funding. Okay. So P and I and F. All the management functions of the firm can be categorized into one or more of these three activities. So P, I, and F. Don't forget, production, investment, and financing. Okay. All of companies' activities are classified into one of the three, PIF. And statement of cash flows is essentially categorized into three parts: operating activity, and investment activity, and financing activity. Operating activity, investment activity, and financing activity. And operating activity is net income. Where does this number come from? Remember, this came from here. Oh. This comes from net income here. Okay. 689. That net income is translated into net income here. Okay. Depreciation and decrease in accounts receivable, decrease in inventory, increase in account payable, increase in other current liabilities, all of them are operating activity, and they're also included there. Cash inflows are pluses. Cash outflows are denoted by minus signs in front. Say increase in other current assets, like raw material increase or inventory increase. Increase in other current assets means that the company has purchased the current accounts. the company has invested in this. Therefore, that's cash outflow. So outflow of 39. And if you sum them up, you have 1175. That's net cash from operations. Investment activities. The company this time has no additional investment except purchasing, selling fixed assets. Fixed asset of 104. So net cash from investments, sale of fixed assets, and 104 comes into the firm. That's cash inflow. Financing activity, notes payable decrease, long-term debt decrease, common stock decrease, and dividends paid. These are all financing activity that entail cash outflows, and with the minus signs in front, total of 641. They are all going out of the firm. So adding production activity or investment operation activity, investment activity, and financing activity, the numbers all together, and adding to the beginning of the year cash, you have end of the year cash balance of 696. This is cash flow statement. Sources and uses of cash. Any questions? In chapter 3, there's a mini case that involves preparing this cash flow statement from balance sheet and income statement. And do that once, and you will feel much more comfortable. In the meantime, we'll have to go. Today we have a lot more to cover. Standardized financial statements, common-sized financial statements. This one is what you will need to do by Wednesday next week. Common-sized balance sheets compute all accounts as a percent of total assets. Inventory as a percent of total assets. Raw material, I take that back. Accounts receivable as a percent of total assets. Cash as percent of total assets. Accounts payable as a percent of total assets. Capital as a percent of total assets. Compute all accounts as percent of total assets. That's to make you be able to compare your company's financial statements with other companies' financial statements, because they are in common size, 100. That's also useful to compare your balance sheet for the year 2014 with 2013's balance sheet or 2013's balance sheet. So comparison of your balance sheet over time as well as across different companies are possible by looking at common-sized balance sheets. I am currently working on a research project that looks at inventory behavior of Korean manufacturing companies. There is really substantial decrease in the proportion of inventory as percent of total assets in the late 90s and early 2000s. From 98, 99 to 2000, 2001, 2002. Substantial decrease in inventory as percent of total assets. The companies are carrying less inventory proportion to total assets. Of course, total assets have gone up, so inventory has gone up too, but the proportion of inventory or percent of inventory as of total assets has declined substantially from 98 through 2002. What can possibly explain this change in inventory position for Korean businesses? Well, I'm just asking you. You can make guesses, okay? I would like to take 3 or 4 guesses of yours and see if you are thinking in the same terms as I do. Why inventory level has suddenly declined toward the end of the 90s and early 2000s? Anybody would give a guess? Eh? IMF. Okay, it's not IMF. It's financial crisis, right? Asia financial crisis causes the firm or made the firm become more concerned about profitability and efficiency. So inventory management efficiency has improved because of the crisis. Okay, number one, crisis. Good job. Good answer. Anyone else? Huh? Consume less. People consume less. Yes and no. The crisis caused the people to consume less. That's true. But how that is translated to inventory position, that's not clear. Okay. Anyone else? Mortgage? I'm not sure. But keep guessing. Keep guessing. Yeah? Bankruptcy? Bank rush? What do you mean? Okay. During the crisis, many of the banks they failed. Okay. That may be a part of explanation. Banks fail and bank provide less money to corporations, and corporations need to become more economical in carrying their inventories. Okay, that might be an explanation. Other explanations? Your name? Chun Kwang-hee. Chun Kwang-hee made an interesting remark because of digitalization. You know, when internet became widely available in Korea? Internet. Did smartphone exist in 1997? No. 1997, I used to have a mobile phone. The size of the mobile phone is bigger than this. That hardly fit into my pocket. Internet was not widely available in the mid-90s, and internet became much more widely available after the financial crisis. So that's the time that digitalization is more prevalent, and digitalization caused inventory management much more efficient. That's another explanation. So crisis, digitalization, or IT revolution in more general terms. What else? Labor price. What do you mean? Labor price has decreased, increased? Labor price has increased. And yes and no. Labor price has actually increased. That's not for sure. But there may be some truth in your answer. If labor price is too high, then the company would like to make it less labor intensive. So inventory management will use less labor and try to become more efficient. And because of this efficiency, added efficiency, the company maintains fewer inventories. Okay, that's possible. That's a possible answer. Anyone else? One person gave, in the previous class, one person gave an answer. It may be because the companies became more proficient or capable of forecasting demand. Demand forecasting. People carry inventory because demand is uncertain. If you know the demand, you can carry minimal amount of inventory. But demand is uncertain, so you carry some buffer amount of inventory, and inventory level is higher if forecast is uncertain. So forecasting accuracy has improved around the turn of the century, and that's why inventory level has come down. That was a good answer too. Okay, anyway, common size balance sheet and common size income statements are used to think about these things. Standardized statements make it easier to compare financial information, particularly as the company grows. They are also useful for comparing companies of different sizes, particularly within the same industry. Now, let's move on to ratio analysis. Ratios allow for better comparison through time or between companies. As we look at each ratio, ask yourself what the ratio is trying to measure and why that information is important. Ratios are used both internally and externally. And ratios can be categorized into 5 broad categories. Short-term solvency or liquidity ratios, long-term solvency or financial leverage ratios, and asset management or turnover ratios, or so-called activity ratios, profitability ratios, and market value ratios. Instead of going through each and every ratio separately, how to compute that, how to use the information, it's too tedious, and I don't have the patience to go through that. So I will leave that up to you. You read your textbook and you learn yourself. Instead, I'm going to talk about a real case that I created. Okay? Here is a case called Green Paint. This is a hypothetical company that I hypothetically consulted back in the early 90s, but I changed it into more recent time data. Assets and liabilities and capital, so-called balance sheet information, are available from year 2006 through year 2010. And look at this total asset size, 926,000. It's a small company in Buffalo, and it has grown just a little bit to $1 million by year 2010. So this is a real tiny, small company, paint manufacturing company. Assets increase is not that big, but bank loans started with 85,000 in 2006, but it has risen to 132 in year 2010, almost 60% increase. So assets haven't grown much, but bank loans, borrowing has grown quite a bit. So the company is relying on more debt as it has grew. This is the balance sheet. And look at the income statement. Sales, 2.9 million in 2006 and 2 million in 2010. And this is caused me, it was shocking to me when I first saw these numbers. I thought that these years are misplaced. This one is the most recent and this one is the oldest. But the real, the company's financial statements show that 2006 it was 2.9 million and 2010 it was only 2 million. So the company, instead of growing, it has declining over time. Everything grows. Everything grows. Every living thing grows. But this company is not growing. It is actually shrinking. This is a funny company, right? Look at income before income taxes. Okay, net income was 15,000 in year 2006 and only 3,000 in 2010. So the company is not getting better; it is getting worse. So you know what I usually do when I look at a company as a consultant or a financial analyst of a company? I usually look at about 4 or 5 things, so-called my dashboard. I have my dashboard. When you sit in the driver's seat of a car, you see dashboard. There's speedometer here, and the fuel gauge, and the temperature gauge, well, many of the gauges in front of you. They tell you what the conditions of your car are, okay, at the moment. For the company, I look at about 4 or 5 different items. They are on my dashboard. Number 1, net sales. I look at net sales. How actively the company is selling. Is there any growth in net sales? Number 2, bottom line, profitability. Is it profitable enough? Okay. And number 3, going back to the balance sheet, leverage. How much debt is the company using? Number 4, cash position. How liquid is this company? Does the company have enough liquidity? Okay, these are the things that I typically look at before I analyze a case. Okay? So I want you to have similar items on your dashboard. You are analyzing your own company, and your company analysis should have these things. Okay? Is the company growing? Is the company profitable enough? Number 3, the company, how highly is it leveraged? How much debt is it using? Number 4, how liquid? How much cash does the company currently possess? So the next page show you ratios calculated for 14 different ratios. And I asked you to compute the ratios and compare the ratios with the industry average. But to save you time and energy, I did it myself. And I asked you to pretend as if you were an analyst of this company. And I'm going to listen to your evaluation of this company, okay, in the next 15, 20 minutes. Okay. I know that you've already discussed among your group members as to how good each and every ratio is. So I'll ask, number 1, current ratio. Current ratio is, read this formula, okay? For each dollar of current liabilities, how many dollars of current assets you have. Okay? Current liabilities are the liabilities that will come due within 1 year. It can come and the liability holder may come to you and say, pay me within 1 year. And you have to have assets to pay back, but within 1 year. So current assets, how many dollars of current assets are available to pay back $1 of current liabilities? Okay, that's $1.42 for each dollar of current liabilities. Industry average is 2.1. So is it good, bad, or terrible, or hopeless? What? At the count of 3, I want you to say in unison what your answer is. Okay, 1, 2, 3. Why? 90% of you are quiet. Let me do it again. 1, 2, 3. Still 80% of you are quiet. Okay, the first one, this one. Let's give C, okay? Quick ratio. Quick ratio is similar to current ratio, but among the current asset items, inventory lacks liquidity. It's hard to convert into cash fast enough, and you will have to incur substantial loss in value when you liquidate. So subtract inventory from current assets and call that quick assets. And how many quick assets, those that can be converted into cash quickly, do you have for each dollar of current liabilities? And the company has 55 cents for each dollar of debt. And industry average is $1. So how good is this ratio? 1, 2, 3. No consensus? Oh, it's even worse. A, B, C, F, and one person says B, C, and F. I will do it again. Whichever voice is larger, I will take. 1, 2, 3. I hear C, although I hear B, louder voice here, but I think more people are saying C's. Debt to equity ratio. Debt to equity ratio. For each dollar of my money, how many dollars of other person's money the company use? Okay? Debt to equity ratio. This ratio is a little confusing in Korean. In Korean, this ratio is called 부채비율, like debt ratio. But in Korean, it's 부채비율, but the 부채비율 is computed as debt to equity ratio. So whenever Korean newspapers show 부채비율, that's debt equity ratio, debt to equity ratio. Debt equity ratio is 1.48 versus 1. How good is it? 1, 2, 3. I hear only this side and that side to say something. How come this is silent? 1, 2, 3. C. Okay. Since she says C, I will say C. Okay. 4. Gross profit as percentage of net sales. Gross profit is net sales subtracting variable cost. Okay. Gross profit 25% as opposed to 29%. 1, 2, 3. Okay. A lot of you say B. 5. Net profit margin. It's net profit before tax. Typically, it is after tax, but in this example, I use before tax. NP before tax divided by net sales of 0.15 as opposed to 4. 1, 2, 3. There's unanimous F. 6. Total asset turnover. This is sales, I'm sorry, it's not sales. Net sales divided by total assets. Net sales divided by total assets. For each dollar of net sales, how many dollars of net sales does each dollar investment in total assets generate? Okay, that's this turnover, asset turnover. 1.9 versus 2.3. 1, 2, 3. Loud voice of B. 7. Return on assets, profitability, profit divided by net profit, the total assets. 1, 2, 3. That's unanimous. 8, of course, it's F, right? Return on investment also F. Inventory turnover. Inventory turnover. That looks a little confusing, but think it this term. By maintaining $1 of inventory, how many dollars of sales the company generate? Okay. How many dollars of sales are generated by maintaining $1 balance in inventory? Okay. The company's inventory turnover is 4.2 and it is 4.9. 1, 2, 3. Inventory days, or days of sales in inventory, is how many days is your inventory maintained within the firms? Okay. If inventory turnover is 4.2, divide that into 365. It will give you how many days inventory is kept within a firm in each cycle. And it says 87 days as opposed to 70 days. The smaller the inventory turnover ratio, the longer the days in inventory. And it's essentially measuring the same thing. And of course, based upon your answer, it is B, 11, 12, 13, and 14. Only 4 more left. Okay? And I will give you a grade. Okay? Accounts receivable turnover. For each dollar maintained in accounts receivable, how many dollars of sales does that generate? 11.7 as opposed to 8.9. 1, 2, 3. See? Now you are getting it. That's A. And collection is very fast. It takes only 31 days as opposed to 46 days. And payable turnover, it's very similar to receivable turnover, but the other side. Okay? The payable period is more. It's better to understand it. It takes 60 days for the company to pay back the vendor of raw materials. And it takes 60 days as opposed to 39 days. Now, your evaluation. 1, 2, 3. This is very uncertain. Let's call it C. Okay, my answer. Okay, my answer. I am really tough. Overall, what is your assessment of the firm? Overall, what is your assessment of the firm? Yeah, overall C, and my overall score is C or F, somewhere in between. Okay, so notice that how tough I am in grading. So, are you getting nervous about it? Okay, for the next 10 minutes, I'm going to give you interpretation, primarily for those that have a difference between you and me. Liquidity ratio, by looking at it, the company's readiness for current liabilities payment is weaker than industry average. The company has fewer dollars of current assets for current liabilities. So by looking at these numbers, you can say that a company is short in cash. The company doesn't have enough cash. So keep a private note, a separate sheet of paper, and write in your own language, Korean, Chinese, Japanese, or English, or German, or French, Spanish, whatever language you have. Write it down, something like little or no cash. The company cash position is very low. You can immediately tell company's cash position is too low. Go to debt ratio of C. The company uses more other people's money than your money. So the company is, in some sense, riskier than other companies in terms of financial leverage. If debt holders require you to pay back, then the company may not be prepared to pay back. The company doesn't have enough capital to pay back the debt. So maybe too much debt. Number 3, profit turnover. This thing, you and I disagree very much. Okay, you say B and I say F. How can that be? How can that be? Now let's look at this. Here's net sales, and here's gross profit and net profit. And here's green paint, and here's industry average. Net sales are the same, 2,000. Think about a hypothetical industry competitor, which is same net sales. Gross profit of the firm is 500. Industry average profit margin is 29%. So 2,000 times 29% is 580. The difference between the two is 80, right? Net profit before tax is 3. Industry average is 4.1. So 4.1 times net sales of 2,000, hypothetical sales, that's 82. So the difference between the two is 79. So 79 difference. That's very big. That's why you gave an F to this company. This company's profitability is really, really, really bad by looking at net profit margin. But this 79, the most of it comes from where? This one. Now you can say that this difference doesn't look too large, but if you see that as the main source of this discrepancy, you can see that this difference is not a marginal, it's not insignificant. It's a significant difference. So gross profit. If the company had been as profitable as the industry competitor, it could have earned 580, and it could have generated $82,000 of net profit. But the company's gross profit was only 500. Therefore, its net profit is only 3. So gross profit is problem. So your next one is terrible. Let me not use terrible. Just poor. Poor profitability. Now, profitability comes in 2 ways. Number one is cost is too high. Profit is revenue minus cost, right? Profit is, by definition, revenue minus cost. Revenue is P times Q. P is a price, Q is quantity. Cost is C times Q, right? So it's P minus C times Q. Cost may be too high, or price may be too low, or both, right? Do you understand this? This is what financial analysis is all about. You just keep thinking about related aspects about the firm's operations. Number 4, total asset turnover. Asset turnover is net sales divided by total assets. And total asset turnover seems too low. And what does it mean? If asset turnover is too low, that means sales are poor, or too much assets or both. Right? So you just keep writing down your guesses. And when you're done with your guesses, you can see, the company is problematic. This is how you find out what the problems are. What are the problems? You are identifying problems with the company. What are the problems? And you are identifying some of those problems this way. Okay. One more thing I'll do, and then the rest of it I'll do it on Wednesday next week. Tuesday again I will do review session. So Wednesday I will finish up this discussion of financial ratios. Here, return on assets, ROA. This is very critical. Let me use acronyms: net profit after tax or before tax divided by total assets. Right? That's the definition of it. Now multiply the upstairs and downstairs, numerator and denominator, by net sales. Net sales. And change the position of the denominators. You see that the first one is net profit margin times total asset turnover. Are you with me? So this is decomposition of return on assets, this ratio. Return on assets is decomposed into two parts: margin and turnover. And as you have said, margin was bad and turnover was bad. So margin is bad, turnover was bad. Bad times bad, bad squared. Right? So it's terrible. Okay? Terrible results come here, total asset turnover. And return on assets. It's terrible. It's very bad because margin is bad, turnover is bad. Right? Okay, the next one, ROE or ROI is net profit divided by equity. Let's use EQ. That's that for equity, okay? Multiply this same thing, net sales, total assets, and total assets. Same thing, right? It's multiplying one by one, okay? So it remains the same. And change the position, bring net sales to here, total assets to here, and equity to here. And rearrange the terms. It's net profit margin times total asset turnover times equity multiplier. Net profit margin and total asset turnover, that was ROA. So ROA times equity multiplier. And equity multiplier, EM, equity multiplier, is nothing but equity, total assets divided by equity. And total assets are equity plus debt divided by equity. And that is 1 plus debt over equity. You've already seen it. That's debt to equity ratio. So ROE has three components: profit margin, activity ratio of total asset turnover, and 1 plus leverage ratio, 1 plus debt to equity ratio. So 3 components are multiplied together. So this is, in a sense, composite measure. And of course, this was bad. And this analysis, the net profit margin is telling you about profitability of the firm. And total asset turnover tells you about efficiency of asset management. And equity multiplier tells you about leverage of the firm. So financial analysis is used to examine the company's profitability, to examine company's efficiency, asset management efficiency, and to analyze company's financial leverage. So financial leverage is a powerful tool, especially ratio analysis is a powerful tool to understand company's profitability, company's efficiency and activity, and company's riskiness, financial riskiness in terms of leverage. Are you with me? Does it make sense? All right. Inventory turnover through payable period, they are all about efficiency of the company, management efficiency of company's assets. That I will discuss on Wednesday, a week from today. And for Tuesday, I will give a review session. And on Wednesday, what I'm going to do is rest of it, plus growth financing. The company grows, and how does the company finance growth? Okay, that is going to be described in the following. Okay, I'm not done yet. Here's look at the cash cycle. We talked about it last week, and we also talked about it today. Here's DuPont identity, exactly this one. Here's using DuPont identity. This is the data to use to apply DuPont analysis. And this is essentially one chart that shows you how each component of the company's asset items or expense items contribute to the company's profitability, efficiency, and leverage. Why evaluate financial statements? It's up to you. Benchmarking, up to you. Potential problems, up to you. Comprehensive problems, up to you. Now, the last pages. This is not in your class note, but next note, class note number 4, has this and the following page. This is the case that I will be discussing. Another case, in-class discussion I will do. Here's a company called ABC Corporation. ABC Corporation's balance sheet for year 2009 is given. And the company has no borrowing, very safe. And cash position is 2.35, not bad. Quick ratio is very good. Debt to equity ratio is very good. The company wants to grow 70% in 1 year. Sales of 500 is to be increased to 850. So this is a growth firm. Very nice. Fast growth. You have stellar performer in the market. Net profit is expected, and that is to be retained. No dividend paid. But the company's balance sheet for year 2010, so-called pro forma balance sheet, forecasted balance sheet. By using the information here and using the income statement information here, I want you to come up with this pro forma balance sheet. But actually I did for you. So I want you to verify that all of these numbers are correct. And I'm sure that they are correct because I double-checked. Okay? But I want you to see how you can create this pro forma balance sheet this is the topic of next week. Topic of next week is how to create pro forma balance sheet to find out how much money you need, how much financing you need. This is red letter, a red number. How much financing do you need? It goes in this way. You start with cash. You fill out these numbers all the way to the bottom, to total assets, and move to the right and write it down because balance sheet must be balanced. And going back up this way, net worth will be 310 plus the income retained, and going back up and up and up and up and up, and this number will be the residual, the last number that you will find, so-called plug-in number. Plug. That plug number. Okay, you are supposed to find this number, 144.5, and look at the company's balance sheet. How good is this company after phenomenal growth? How good is this company? Okay, that's our discussion for next week. So be prepared to discuss it as you prepared for today's ratio analysis very well, and for next Wednesday's class, prepare for that. Project, you are done with this. I'm reasonably satisfied with, I checked some of your report and they look very good. Next week, you're supposed to give financial statements, common size financial statements, and major financial ratios for the past 3 years. If you find any unusual activities in the financial statements, do write down what they are. Okay, point that out. Okay, exercises and questions and thanks. Okay, any questions? Any questions? Okay, that's all for today, and I'll see you on Tuesday during the makeup session.